In this lesson, you're going to learn about how to project cash flows for Apple. And actually, much of the work here we've actually already completed because in our three-statement model here, we have a lot of these items already filled out. We have revenue, operating income, net income, taxes, and on the cash flow statement, we have many of these items filled in as well. So actually, much of our work here is already done, and a lot of this will be simply linking in from our existing three-statement model. Not everything is going to flow exactly from there, and so I will go through some of the items that are different, but for much of this, we're just going to be pulling directly from the model that we already have. Now, when you're working at a bank and you're doing a DCF analysis, whether or not you do this depends greatly on what kind of other analysis you've done for the company. If you have a complete operating model, as we do here, then you would just pull in from there, as we're doing in this example. If, on the other hand, you don't have a complete operating model, and maybe you only have equity research, for example, then you would probably create something similar to this, except you would actually include some of the assumptions that we have over on our three-statement model about revenue growth, expenses as a percent of revenue, tax rates, and so on. And you would actually include these on the DCF analysis instead, and you would actually make your own projections right there. We're going to take the first approach and just pull in from what we've already completed because that just makes the most sense in this case. Now, I mentioned that not everything is going to flow in directly from the income statement and cash flow statement. So what I want you to do now for your exercise in this video is to pull in the items that do flow directly from those statements. So I'm going to highlight them right now. Revenue, EBITDA, and operating income as one set. And then depreciation, amortization, and stock-based compensation as the other set. So right now, you should pause this video and go into this Excel file and actually go and try to pull in all the data yourself based on what's in the three-statement model. Remember that control page up moves to the left, control page down moves to the right when you're working with worksheets here. So control page up and control page down to move around. Once you've done that and pulled in all these numbers, to check your work, you can unpause the video and then I'll walk you through it and show you exactly where to get this information from. Okay, good. So here's what we're going to do. So for revenue, EBITDA, and operating income, we can pull all of these from the income statement. So I'm going to press equals and then control page up to go over to the three-statement model. I'm going to go down to the income statement here. For discounted cash flow analysis, we always want the forward numbers. We don't care about historical numbers, so we're always looking at forward projected numbers here. So I'm going to take the 2010 number for revenue. For EBITDA, again, I'm going over to the income statement. I'm going to go down to EBITDA right here. And then for operating income, the same applies. I'm going to go to the three-statement model and go over and pull in operating income. So we have all those, and I'm going to highlight these and just copy them over once again. We have not anchored any of the cells, so everything copies over correctly, and we have revenue, EBITDA, and operating income all the way through 2014. One tricky point here is when you're copying in the operating income, you have to be careful that you're taking the operating income listed here and not the EBIT number. The difference is that operating income here includes the effect of stock-based compensation, whereas EBIT excludes that and takes it out. You want to be taking this number because for this analysis, remember, we're trying to get to unlevered free cash flow. Unlevered just means that we're taking out interest expense and interest income. We are still including depreciation, amortization, stock-based compensation. So we're still going to see the effects of all of those in this unlevered free cash flow number. All we're really doing here is making sure that interest income and interest expense do not show up. So for the other numbers here that I told you to pull in, for depreciation, amortization, and stock-based comp, we can actually go to the cash flow statement to pull all of these. And they're listed right here, D&A, amortization, and stock-based comp. I can actually just highlight this whole area using the Shift key and just paste all the formulas. Now, I mentioned before that not every item is going to flow in exactly as you'd think from the income statement and cash flow statement. To show you what I mean by that, I'm going to go through these last three remaining items here: taxes, working capital, and capital expenditures. So for taxes, what we're going to do here is, if you remember from our three-statement model, we calculated taxes on the income statement here based on the pre-tax income number. Well, the problem with just applying this income tax provision number that we calculated here is that we're including interest income and interest expense in this tax number. We want to make sure that it's removed. So what we want to do here instead is apply Apple's statutory tax rate or effective tax rate of 30%. We want to take that and apply it to their operating income right here. So for this taxes number, we're going to take operating income and then multiply it by this named cell tax rate. I also want to make sure the sign here is negative, because as you see right here, we're going to be subtracting taxes. Copy this over. Now, for these next two items, working capital and capital expenditures, I found that there is a lot of confusion, especially on the working capital line item. So here's how I would think about this one. By increase in working capital, what I'm referring to is on the cash flow statement, this area, changes in operating assets and liabilities. These are all considered working capital line items. And basically what we're doing with the DCF analysis is we're trying to replicate the cash flow statement down to cash flow from operations by looking at the income statement and then making sure that the net income here does not include interest income or interest expense. So we're trying to replicate the cash flow statement. Now, if you think about that for a minute and you think about the numbers here, what's really happening here is if we just sum up the changes on this area right here, this is a positive number. And if you think about it, that means that working capital is actually going down. When working capital goes down, it means the company does not need as much cash to fund its operations. And on the DCF analysis, we want to be showing a decrease to our cash flow if they need more working capital, and we want to be showing an increase to our free cash flow if they need less working capital. So what we're really doing here is subtracting the increase in working capital, and vice versa. If working capital is decreasing, then we're adding the decrease in working capital. A lot of models you see will just have this shown as changes in working capital, but I think that's very confusing to think about it like that. I would think about it like this, that if you're increasing the working capital in your company, then you have to subtract it. If working capital is decreasing, then you add it, because that means that you do not need as much cash to fund working capital and you can free it up to use it for other purposes. So in this case, I'm going to use the sum function and go back to the three-statement model. And what I'm going to do is just sum up these items right here. So accounts receivable all the way down to other liabilities. Copy this across. So we see what's happening in this case is that our working capital requirements are decreasing over time. We need less and less cash available to fund the operations of this company. What that means is that we have more cash available, and so our free cash flow here is going to go up. And that's how I would think about how to factor in working capital into a DCF analysis like this. For the last item here, for capital expenditures, let's just go back once again to our three-statement model, go down to investing activities on the cash flow statement, and we can just link directly to capital expenditures right here. The only tricky thing here is to make sure that the signs are correct. In this case, we are subtracting capital expenditures, so the signs are correct here. We have a negative. But sometimes, depending on how the model is set up, you could have a positive sign here. Capital expenditures, you pretty much always want to subtract. There's no such thing as having a negative capital expenditure. You're either spending the money or you're spending nothing. So capital expenditures are pretty easy to keep track of. You just have to make sure that the sign is correct and that this is always a negative in your DCF analysis. So now to calculate the unlevered free cash flow. So what we're going to do is start with operating income. We're going to subtract taxes, add depreciation, add amortization, add stock-based comp, subtract the increase in working capital. So in this case, we're actually adding the decrease in working capital. and then we're going to subtract capital expenditures here. So we have that, and I'll copy it across now. And so that gets us to our unlevered free cash flow number. Now, just for comparison purposes, let's go back to our three-statement model and see what our levered free cash flow number looks like. So if we take the 14,491 here and add capital expenditures, so you see in year one, it's around 13 billion versus 12.8 billion, going up to around 17 billion in 2014 versus the 19 billion here. So overall, levered cash flow in this case is actually higher, which is not surprising because if you remember the structure of Apple's income statement, they actually have a lot in interest income here, some interest expense, but mostly interest income. So in this case, levered free cash flow is actually higher. So what we're going to be doing next is taking this unlevered free cash flow number, which is showing us on a capital structure neutral basis how much cash flow from business operations is the company actually generating. We're going to take this number and then discount it to figure out what the present value is. Because remember that the 17 billion we get 5 years from now is going to be worth a lot less than if we had the 17 billion today. So we're going to see how we actually apply a discount rate to figure out what the present value of this free cash flow actually is.